Hello, welcome to our presentation on construction analytics. We start off with this thing. In this, we'll cover what we have exactly got to offer within construction analytics. 1 second. So basically, a construction analytics module has got 5 sub-modules: inventory, labor, contractor, and so forth. And these are the 5 business benefits that accrue because of construction analytics. Today we'll be looking at answering the question, basically the forecasted cost or delay analytics based on these 5 modules. So, but we answer specific business questions which entail specific modules. These are the modules which form part of the construction analytics module. So, site management module will come inbuilt. Then the financial management module is the green. So the budget management module and the contractor are in process. The inquiry management and the plant and machinery and the property configuration will be made in the future. Then account management is basically that how do you handle the account once the order has come. Booking and sales is for the orders which have been booked. Then how does one handle it? Property configuration is what is the configuration, what configuration of properties do you want to have. Inquiry management, contractor management, labor management, and inventory management are all self-explanatory. This is for the sample client, so we'll actually go through it. So these are some of the sample clients. So within construction analytics, we look at how to find the cost of delay. We are looking at all the modules. We offer the complete range of services, starting with data capture, data modeling, up to data mining. This is about the data design. So we basically use the Kimball and the Inman methodology to design third normal form data warehouses, and we have confirmed data dimensions. This is a list of the metrics which we will give within each module. So you have actual versus target, then you have financial management, which is what we are looking at, forecasted cost of delay calculations. Then sales management, you have the customer receipt tracking, the historical analysis. Inventory is a separate module, so we have the safety stock analysis as part of the same, the contractor analysis, and the labor analytics. So this is a sample case study for one of the clients. So the client had all the milestone data in number of spreadsheets which were in different format for all the projects. So the problem was that the client was not able to consolidate the data from the spreadsheets. So the deal was that they wanted to know the actual and the target milestone status, have drill down and drill through capabilities, generate standardized metrics across all the projects, and use the system across large number of users. The business benefits are these. They basically were looking at reducing the cash flow cycle time and reduce the risks and understand the project viability and do better planning and forecasting. And the operational benefits were that they were looking at removing the duplicate entries between SAP and Excel and reduce the time for analysis. Construction industry has got a number of external parameters. So these are the parameters which were into consideration: the appreciating land prices, the changing government regulations, changing interest rates. So these actually add these factors actually add unpredictability to the model. So we have actually looked at this thing. The other aspect which is very common is that the amount of data within construction industry is very low. So data is not that easily available, and the number of reporting end users is this thing. And implementation is a tough ball game. We did all these 5 processes to this thing. Now, first of all, is we removed the manual Excel report. So this is my combined milestone target versus actual. This is a typical S curve. So this is for both milestones as well as for the cash flow. So you automatically generate the BCWS and the ACWS curves. In this particular graph, the x-axis has been changed. So instead of it being the date, this is actually a target date. So, and this is for the projects across month, year, and month and the year, fiscal year and this year. So basically what this graph says is, say my target milestones for this month for 100, I actually achieved 120. But out of those 120, only 80 were valid. So this graph will say that's 80% achievement for this month, and the remaining milestones will be adjusted across the other months. Then we look at the reasons for the cost of delay. So a site management module looks at the cost, tracks the delay. So for example, I have this target date delay analysis. So if I extend the date time of the project, so for this particular project, I can drill down by block, plot, flow, unit number. This is the cumulative target date delay analysis. This is the reasons for delay by the project. So I have by remark, drill through the project, drill down to the block. What are the reasons? So I have what are the reasons which are associated with it. These are the remarks associated with the project delay, and you can drill through to the task details. And this basically shows year and the fiscal month, project, milestone name, what has been the cumulative shift in the target dates. Then this is actually showing the costed delay in the project. So this graph is actually extending from the prior graph. So you have the project, the target date, you have the total delay by block, drill down to the flow, drill through the milestone and remarks. This is the interest cost. So the interest cost which we have assumed is the cost of the delayed collections, as well as the cost which is associated with the loan reimbursement because of the delay in the execution of the project. So I have the month drilled to the plot, block, plot, remarks, drilled down to the milestone. This is my costed delay alert for a project for the year and for the target date. This is my interest cost of delay. So this is my milestone. This is the type of delay and what is the total cost associated with it. This is the inventory cost. This is the details for the inventory cost by block, by plot, by milestone. What is my holding cost? And for this particular holding cost, I'm looking at the cost of inventory by project, drill down per block, then to the flow. This is my holding cost alert. This is the average cost by block, plot, and then drill down to the milestone. This is the cost of delay for the manpower. So I have employee, milestone. This is the labor delay. What is the cost of the manpower which is associated with the delay for this project for this year, block, and the target date. This is the addition to the labor cost by employee and the type of delay. So employee, drill down to the type of delay, and this is self-explanatory. So then we come down to the next portion, which is the forecasting, the what if analysis. So you have the target date delay simulation. You have to determine the crash cost, the constraints mapping, cash constraint, labor constraint, material, and the NPV and the IRR. So basically you are shifting this target date now. First of all is the issue of a capital rationing. Just say suppose I've got only 600 rupees available. My initial outlay for each of these projects was 100, 150, 250, and this is the additional cost. So I actually cannot do all the activities. So what we do is we forecast the cash flows for each of these projects and then come at the NPV. Now when you forecast the cash flows, you have to also simulate the projected cash flows with the delay. So actually it follows a standard normal distribution, and you adopt probabilistic methods to actually forecast the cash flows. So then you come down to the fact that this project B has got the maximum NPV, then the next one is project D. So basically based on this data, you will do project B and project D. Right. Now what happens is, this is a typical case of capital rationing. So suppose this is my activity crashing program. So I have got a second floor slab, the sixth floor slab. These activities can be done and milestones can be done in parallel. I have to meet the deadline of 21 days. I have to minimize this cost, and which activity to how much to crash is the question. So by this you come down to the required time frame while reducing the cost. So this we have used solver for it, and these are the complete constraints. This can be executed. The risk assessment is that the projects carry a number of external parameters. So what is the risk associated with the project cost and the cost overrun? So you're looking at tight project schedule, the design changes, and so forth. Now let's assume that with each of these parameters you assume the base case cost, and you can have a variability. So you have minimum is say 90%, maximum is 125%. You plot it on a standard normal curve, and then you arrive at, and this is my budgeted cost. So based on the base case, you come at the budgeted cost. So this is going to be the average. The 95% chance of achieving what is going to be the budgeted cost is this 19,928, and there's an 18.05% chance that you'll meet the budgeted cost. Then I come down to the inventory analysis. So again, this is the manufacturer, this is the steel, this is the price, and within the each manufacturer can make available only so much. So you have to procure below this, and the requirement of steel is going to be maximum is this, so it has to be below this. How do you optimize the purchase so that the cost is minimized? This is the cumulative inventory usage. Then I look at the case study for a delay. So this is how it will look in a real-time project. So I have a milestone, I have a target date, original cost, this thing. Now, assumption is that the delay in one milestone will affect down the line milestones in a similar fashion. So we have assumed a linear right now, but that will not be the case. The second is that the reasons associated with delay are associated with manpower, delayed costs of collections, material holding costs. External factors are also considered. So I have this milestone which has been delayed. This is my original cost. This is my new targeted cost. This is the discrepancy between the targeted and the actual cost, which will come up from the trail up, right? So we actually look for significance. That means if like 15 to 16 might not be significant, right? But what you see here is that since this project has been delayed by 1 month, so the cost has been increased from 100 to 140. Then I have the second delay. So now in the second delay, I have got what was supposed to be completed milestone number 5 was supposed to be completed 1/11/2007. It's going to be completed 1/2/2008. But in the meantime, there has been a crash between milestone 3 and milestone 4. So you have this cost 28 to 34. So now there's a significant difference between the actual and the targeted cost, and this is statistically significant. So we need to investigate that. So we basically arrive at, okay, fine, in the project history, which all milestones have had a statistically different cost, and we use a slice and dice and drill down to analyze the same. Then we look at the reasons for interest cost, the manpower cost, the activities have been crashed. We start looking at the macroeconomic variables that are changed during this period. And then we understand what are the reasons between the target cost and the actual cost thing. And then you try and predict the target cost with an because of delay due to with a 95% accuracy, and you look at help managers crash critical activities. This is a sample case for balance sheet and P&L. I have an inflation affecting the cost of materials consumed, and the GDP growth is actually affecting the on-time payment from investors. You identify the independent variables. You also look at the correlations, build the regression model. Then you look at what ARIMA and the PROC ARIMA is, what is the autocorrelation factor associated with these delays, and understand the degree to which the model explains. So you have the gross profit variation. This is the epsilon R. Integration I'm looking at with SAP, Navision, and JD Edwards and Tally. There are new models, accounts. Then you have the construction sales, the contract, and the labor. Thank you very much for your time, and that's it from me.